Now, looking at the shilling, we're seeing a bit of a free fall for the past couple of weeks, hitting a new record low at this stage. Where to from here for the shilling?
Yeah, it was actually pretty surprising that it hit a high of about 102 today. But it's expected because what happens is once it breaks a resistance level, and 100 was actually a psychological resistance level. We've never gotten this high, so it was more or less a psychological resistance level. Once it broke that, I mean, it was expected to shoot up, because shooting up by about 2 shillings in one day, that's quite high, although it closed a bit low at about 101. But it was expected. I mean, from here on, it's difficult to say, because even when you charting, you don't have any previous information to go by. But what we saw, why I think it might have closed at a bit weaker than the high of 102 was because the central bank actually intervened today. Although it was more reactionary than when market opened, we didn't anticipate CBK was going to come in. They've not disclosed the amount the amount of dollars they sold to the market. But it's pretty sad to see that it actually did not have an effect. The shilling still crossed the 100 mark.
Other factors that could affect the shilling going forward, we have inflation figures that are expected out later on this week. They're expected to rise for the 11th month running to about 17.4% in September. The central bank said it expects the inflation rate to slow to about 7.5% by the end of 2011. But with such double-digit figures that we're seeing on a month-to-month basis, that 7.5% target by year-end seems highly unlikely.
Yeah, that's quite true, because we only have about, we only have about 3 months left to this year. I mean, in the last quarter, and although what we have seen is we've actually seen that the inflation level, the rise has actually slowed down, but from double-digit levels of, because what most of the market expects is inflation to come to about levels of 17.40 in September, but basically going back to single-digit figures by December, I think that's highly unlikely. We might see a slowdown, although looking at other macroeconomic factors, just last week, the energy, our local energy supplier KPLC said that we should expect energy prices to go up to an all-time high, because basically the rainfall levels dropping a lot. We're using a lot of thermal energy, and of course we all know what's going on with the global fuel prices. So there's a lot of pressure also from manufacturers locally. I mean, because their cost of imports has, shot through the roof because of the weaker shilling, and now again more pressure will come in from higher energy prices. So we might not see inflation. We might see a slowdown in inflation. We might actually see it stabilize at double-digit figures, but back to single-digit by the end of the year, I think is highly unlikely.
Well, that's a bit of a double whammy for the central bank. They did, however, increase interest rates by 75 basis points earlier this month to about 7%. The rate setting committee is only scheduled to hold a meeting in November. With such high levels of inflation and the weakening shilling, could we see the central bank coming into the market earlier than November?
Yeah, we might actually see the MPC meeting in October, because the meeting they just had about a week ago was unscheduled. The next meeting was to be in October, so basically it was an emergency meeting. So we might see them, they might meet more often to chart a way forward and to look at whether the policies they've put in place have had an effect. Although, the policies that MPC traditionally puts in place are not, we don't expect them to work within a short time. I mean, we usually look at, the reason they meet every 2 to 3 months is because they're long-term. We should see the effect after a longer period of not just a few weeks or months. I mean, the effects usually take place after about 2-3 months, basically a quarter. But this time around, I think we might need, if we don't see them come in, meet again and putting more decisive steps, we might actually see the situation grow a lot worse, especially for the weakening Kenya shilling.
Where would you like to see rates going?
Basically, rates, what we've seen, for example, on the short end with the 91-day T-bill, over the last 6 weeks, it's moved up by about 150 basis points with every auction. We're now at level, 3-month money is now at levels of about 13.19%. which basically means we have an inverted curve because, for example, the 2-year, which was just issued, which was actually valued today, came in at levels of 13.89. That's just shy of about 14%, which is where the 20-year bond is. So it's a bit confused, but we expect maybe what will happen at the short end with the 91-day, because it's actually different from what's happening with the interbank lending rate, which has come down to levels of below 6%. So what I think we'll actually see is we might see the T-bill begin to ease going forward, because this month had a lot of redemptions. So we think maybe that's the central bank was actually trying to fund those redemptions and encourage people to roll over their treasury bills. That's why they agreed for the rate to shoot up to where it did. But we might actually see the short end of the curve all the way from the 2-year, which is at 13.89, begin to ease. Not a lot, maybe slightly, maybe by about 50 to 75 basis points.
Ken, I'd just like to touch on the infrastructure bond, the 20 billion infrastructure bonds due out for tomorrow. What type of demand are you seeing coming through there? We know that the Treasury hasn't issued any bonds for about a year now.
Yes, the last time an infrastructure bond was issued was about a year ago. These bonds have always been popular investors, basically because of the fact that they're tax exempt. This time around, the central bank made it clear they were targeting Kenyans living abroad, diaspora clients. So they've actually ramped up their system. Investors abroad, anywhere in the world, can apply for this bond and do the wire transfers all through the internet. So we might actually see quite some interest from foreign clients, because Kenyans living abroad, not foreign clients necessarily, just Kenyans living abroad, because what we've been seeing is foreign currency remittances from Kenyans abroad every month they've been rising. So I think what CBK is doing, they might be trying to target some of this money that's going into real estate, into fixed deposits in banks. And also this bond will actually stay on tap, meaning it will stay on sale to retail investors until February next year, 2012. So we might actually see, they might actually be able to raise the 20 billion and even cross this mark. And as I said, it's always been a popular bond for your hold to maturity book with institutional investors because of the tax exemption feature.